People can take their seats. Everyone, I note there's a different structure to the committee tables. I don't know whether they were scared there'd be big arguments here between the government and the opposition, but we're about twice as far apart. We're more than 2 sword lengths apart now. In any event, I think it was due to the previous committee being here, and they had a lot of witness, so they had to change the room structure, and we never changed it back. So pursuant to Standing Order 1082, study of the report of the Bank of Canada on monetary policy, we're pleased to have as witnesses this morning the Governor of the Bank of Canada, Mr. Palas, and Senior Deputy Governor, Ms. Wilkins. The floor is yours. Welcome and thank you for appearing.
Well, good morning, Mr. Chairman. Thank you. Good morning, committee members. Senior Deputy Governor Wilkins and I are happy to be back to discuss the bank's monetary policy report, which we published last week. I extend particular greetings to the new members of the committee, which I think is almost everyone. I look forward to being with you twice a year to talk about the Canadian economy and our monetary policy. Carolyn and I were last in this committee about 12 months ago, and it has certainly been a tumultuous year for the Canadian and global economies. Now let me start with a quick review. As you know, the Canadian economy has been dealing with a massive shock to our terms of trade, which is brought about by a sharp drop in the price of oil and other commodities that began late 2014. Comme le Canada est un important producteur.
Because Canada is such an important producer of resources, particularly oil, this shock was a major setback. It set in motion a difficult adjustment process that has been very disruptive for many Canadians. Investment and output in resource industries have fallen precipitously. The decline in national income has curbed household spending, and the resource sector has seen significant job losses. These negatives have clearly outweighed the benefits of lower energy costs for both households and businesses. From a monetary policy perspective, the shock posed a two-sided threat to our economy last year. First, it was a clear downside risk to our ability to reach our inflation target. Second, by cutting into national income, it worsened the vulnerability posed by household imbalances, as seen in our elevated debt-to-income ratio. To address both threats and to help facilitate the necessary economic adjustments, we lowered our policy interest rate twice last year, bringing it to 0.5%.
The possibility that this reduction could, at the margin, exacerbate the vulnerability posed by household imbalances, the more important effect of lowering the policy rate last year was to cushion the drop in income and employment caused by lower resource prices. Another natural consequence of the shock to our terms of trade has been a decline in the Canadian dollar exchange rate. It's important to note that this is not unique to Canada. Indeed, many resource-reliant countries have seen similar depreciations in their currencies. Both our policy moves and the lower currency have been helping to facilitate the economic adjustments, which have been playing out over 2 tracks. While weakness has been concentrated in the resource sector, the non-resource economy continues to grow at a moderate pace. And within that, non-resource exports are clearly gathering momentum. Now, by the time we reached the new year, there was a clear sense of anxiety among many financial market participants. The outlook for global growth was being downgraded again. Commodity prices were plumbing new lows. At the bank, we had new intelligence that Canadian energy companies would be cutting investment even more than previously thought. In this context, we said that we entered deliberations for our January interest rate decision with a bias to easing policy further, but we decided to wait to see details of the government's fiscal plan. Since January, we've seen a number of negative developments. First, projected global economic growth has once again been taken down a notch for 2016 and 2017. This includes the U.S. economy, where the new profiles for investment and housing mean a mix of demand that is less favorable for Canadian exports. Second, investment intentions in Canada's energy sector have been downgraded even further. True, oil prices have recovered significantly from their extreme lows, but Canadian companies have told us that even if prices remain around current levels, there will be significant further cuts beyond what we foresaw in January. By convention, we incorporate the average oil price from the few weeks before we make our forecast, letting us see through variability in markets. But because of all this, our oil price assumptions are only $2 to $3 per barrel higher today than they were in our January forecast. Third, the Canadian dollar has also increased from its lows. Our assumption in our current projection is 76 cents US, which is 4 cents higher than we assumed in January. While there are many factors at play, including oil prices, most of this increase appears to be due to shifts in expectations about monetary policy in both the US and Canada. The higher assumed level of the dollar in our projection contributes to a lower profile for non-resource exports, as does lower demand from the U.S. and elsewhere. As the Bank's Governing Council began its deliberations for this month's interest rate announcement, we saw that these three developments would have meant a lower projected growth profile for the Canadian economy than we had in January. Now, this may sound counterintuitive, given the range of monthly economic indicators that started the year strongly. However, some of this strength represents a catch-up after temporary weakness in some areas during the fourth quarter, and some of it reflects temporary factors that will unwind in the second quarter. The other new factor we had to take into account was the federal budget. For the purposes of our NPR and interest rate announcement, we took a close look at the Finance Department's projections of the multiplier effect of the fiscal shock. Our analysis is that the Department's projections are reasonable and that they are within the range of estimates you would find in the economic literature as well as in our own staff research. There is, of course, greater uncertainty as to how the budget measures will affect growth in the longer term, particularly since they will need to work their way through the household sector. In our report, we outlined the risk that households may be more inclined to save than historical experience would suggest. Compte tenu de tous ces changements,
Taking all of these changes on board, our projected growth profile is generally higher than it was in January. We are now projecting real GDP growth of 1.7% this year, 2.3% next year, and 2% in 2018. Our forecast suggests that the economy will likely use up its excess capacity somewhat earlier than we predicted in January, sometime in the second half of 2017. However, there is more than the usual degree of uncertainty around that timing. It is always tricky to estimate an economy's potential output, and the difficulty is compounded when the economy is going through a major structural adjustment, as Canada is right now. We know that the collapse in investment in the commodity sector will mean a slowdown in the economy's potential growth rate. In the near term, we've lowered our estimate of potential output growth from 1.8% to 1.5%.
date, total CPI inflation is currently below our 2% target. The upward pressure on imported prices coming from the currency depreciation is being more than offset by the impact of lower consumer energy prices and the downward pressure coming from excess capacity in the economy. As these factors diminish, total inflation is projected to converge with core inflation and be sustainably on target sometime in the second half of next year. So, to sum up where we are, while recent economic data have been encouraging on balance, they've also been quite variable. The global economy retains the capacity to disappoint further. The complex adjustment to lower terms of trade will restrain Canada's growth over much of our forecast horizon. And households' reactions to the government's fiscal measures will bear close monitoring. And we've not yet seen concrete evidence of higher investment and strong firm creation. These are some of the ingredients needed for a return to natural, self-sustaining growth with inflation sustainably on target. And with that, Mr. Chairman, Carolyn and I will be happy to answer your questions.
Thank you very much, Governor, for the fairly in-depth overview. Starting the first round of questions, Mr. Sobera, 7 minutes.
Good morning, everyone, and welcome, Governor and Ms. Wilkins. My first question deals with the efficacy of fiscal stimulus, and I won't get on the topic of fiscal multipliers, Governor, because I believe you've answered a few questions on that and talked on that in the last few days. But in an environment where we have excess capacity, and in an environment where interest rates are at the lower bound, if you can comment on the efficacy of the government implementing a fiscal stimulus plan. That'll be my first question.
Sure. In general terms, we've known basically since Keynes wrote about the Great Depression in the 1930s that monetary and fiscal policy have their moments when they have their greatest impact. Monetary policy has its least impact as interest rates get close to the lower bound, which is to say people have already borrowed to buy homes or to buy cars, companies have borrowed perhaps to do investments and so on, and lowering interest rates that little bit further has only a marginal impact on the side. But it is in that very context, when we're in that neighborhood, when fiscal policy has the largest impact of all the possibilities one could contemplate. And the reason is simply that when we have models of the economy and we simulate fiscal policies, normally we start from a position of equilibrium. We are far below Canada's equilibrium at this time, plenty of excess capacity. And so in this context, there are no other movements anticipated, such as interest rates or exchange rates, that would partially offset a fiscal change. So it's in that sense that it has more power for the amount of fiscal action one takes than monetary policy in this setting.
Okay. Moving on to a second question, just briefly touching upon inflation, if I do so. If I look at the wage pressures faced in Canada, and I believe we're running at about a 3% clip, and please correct me if I have that incorrect. And that number, there's a pretty strong number, and I know they monitor that data in the United States quite closely. We're having some wage pressures pop up, but in a sense, we still have a lot of excess capacity. And so, my concern is there a chance for, and you've touched upon this on your opening remarks, for inflation overshooting that 2%, the core inflation rate, and overshooting 2% earlier than possible, or that you projected, excuse me?
So at this time, we would put very low risk against that eventuality. We have a range of estimates for the level of capacity in the economy. We take kind of a mid-range of that range of estimates, but a considerable uncertainty about how much there actually is. The situation is quite in contrast to the U.S., which is, I would say, a good year ahead of us in this process of converging. And so, of course, economists watch all of those signals, as you mentioned, that as you approach full capacity, you may begin to see wage settlements beginning to pick up. It's one of the early signs that inflation is getting ready to recover. And it's at that time that the risk management approach to monetary policy sounds that warning, and you begin to deal with that. But just to bear in mind that this is not it's not as exact a science perhaps as we tend to convey. What we think is that the level of potential will be growing as of this later this year and next year because of the investment that's happening in the rest of the economy, and that moves that eventual limit on the economy farther out.
And, going back to economic growth, we had a terrific Q1. I think it was 2.8% growth that was recorded in the Canadian economy. And I think your forecast, or the bank's forecast for Q2, is 1% and 2% for the year, which and you've noted temporary factors. And I think the word is unsustainable, and so forth. I'm a little curious in terms of the deceleration going from Q1 handing off to Q2. It seems to me going from 2.8 to 1 is a marked deceleration. So I don't know if the word is the bank is being too bearish. And I was wondering if you could comment on that, because I think some of the private forecasts have actually bumped up the Canadian growth rate for 16. So I'm just wondering if maybe the recovery in commodity prices, the strength of the handoff and strength to the non-resource sector is actually stronger than the bank may be estimating. So I'd like your comment on that one as well, please.
Okay, well, even the 2.8 that you mentioned is still a forecast, so we've got some time to go before we know these things. But Carolyn, perhaps you'd like to walk through some of the details. You don't have to touch it.
To do is look at what are the factors that are reflecting underlying momentum, and what are the factors that appear to be contributing to quarter volatility, and that's what you've observed. Specifically to this instance, we see a couple of things. Don't want to go through them all, but there's volatility in the inventories through quarter 4 and quarter 1 that will affect that quarterly pattern going into Q2. We've seen also some other factors with respect to autos and auto production that clearly doesn't look like it would be sustainable. And I think the third factor is exports. So exports started the year very strongly, and in fact, if you compare it to what you would expect exports to be, given what we think foreign demand is, and particularly foreign demand from the U.S., it looks like exports were a little bit stronger than you would have expected, and so we've taken a cautious approach to that outlook, and think that there'll be some give back in subsequent quarters. Now, of course, that could be overly cautious. We see the volatility in that export data. The last data point we saw wasn't that great. But I think the bottom line is that we tried to find the best quarterly pattern given the underlying factors that we're seeing. On the export side, we have identified that as a potential upside risk going forward because we've been cautious in our outlook.
Okay.
To cut you there,
Yep.
Francisco.
Thank you.
Rate, 7 minutes.
Thank you very much. Thank you, Governor and Senior Deputy Governor. Very nice to meet you both, and thank you for being here today. I'm going to focus on one aspect of your analysis, and it has to do with determining whether or not, obviously, the measures that the government has introduced in the budget is going to add to the growth in the country. In your report, you indicate correctly that it's about $11 billion in infrastructure investments and about $12 billion in households. And you think that the effects will be felt in 2016. And that forms a basis for your analysis that it's in a sense that it's going to help and overwhelm the negative factors we're seeing in the economy. But you also have two really important caveats in there. And one has to do with households and whether or not they're going to be spending. You also point in the very next section that household debt actually has gone up in this country because more mortgages are being taken on in Ontario and BC. And of course, we're seeing the negative effect on housing markets in the oil-producing provinces. So with all of those taken into consideration, I do want you to expand a little bit about your comfort level of saying that putting money into the hands of families in this country is necessarily going to be spent in the economy and move it along when we're looking at such high levels of debt, a propensity for people to save or pay down that debt because they are concerned about whether jobs are being created. And I would overlay with that one anecdote, I suppose. it's very difficult to see cousins and brothers and sisters and friends across the country losing their job and seeing a lot of discussion about the oil sector, and you refer to it as a structured change in our economy. They're seeing that, and they're very concerned about what that means to them. So just tell me a little bit of how the council ended up deciding that people will actually spend this money instead of saving it. And I would say one last thing. In terms of the tax cut that we have before us that the government has introduced, it amounts to 90 cents a day for an individual. And I fail to see how that's going to be something that spurs on a great economic growth that's going to counter what we're seeing in terms of the losses in our country. So with that, I'll turn it over to you.
Okay. Well, so many of the things that you mentioned are important factors in this analysis, and I think we've been very clear that this analysis has a certain amount of uncertainty associated with it, and as you mentioned, it's why that we chose to highlight one of the risks, which is that people may save more than in the average through history. And we saw an experiment which was similar to that a year ago, because when the UCCB changes went into place, we began with an assumption, which is really what it is, because we began with an assumption that perhaps around half of that money would end up being spent, and the other half might be saved in the context we found ourselves. And that turned out to be not too far off the mark. And so when we put this in, we don't assume everybody spends all of the money. This is a multiplier which is less than 1. Which is that some of the money inevitably is saved, and it will depend on house to house. And as we say, it will depend through time. So it's not just right away. So in the beginning, people may be more cautious than they are longer term. And so yes, there is uncertainty there, and but our monetary policy doesn't require that we have our forecast, exact. What it is about is what are the boundaries, what are the risks around our forecast, so that our monetary policy appropriate for a range of possible outcomes.
Last year, when you appeared before a committee, Governor, you talked about the housing market, and you had an interesting statistic with respect to concerns in the housing market, and you said in your report that the markets were overpriced by about 10 to 30%. And I know that my former colleague, Chambers Jott, and you had a discussion about that at committee. I'm wondering if you think we have a housing bubble in Canada at the moment, because things certainly have deteriorated in the economy since then, and we are seeing severe situations in the prairies in Alberta, for example, where my colleague Ron is from. And I'd just like to get a sense from you where the housing market is a year on from when you appeared before this committee last.
So let me just clear up something on the facts, and then I'll turn it over to Carolyn. And so in the context a year ago, we were reporting a new piece of research which we had published, which made an attempt to analyze housing markets globally, not just Canada, but global housing markets, in cases where there had been periods of overvaluation and then adjustments, and its attempt to understand the fundamentals. And that came in the context of a number of other studies which others reported, where there are a wide range of estimates of whether the Canadian market was overvalued, whether you could even say something like that about the Canadian market, since it varies so much from region to region. And our conclusion was that those kinds of figures are very risky to appeal to, given the variety of experiences we have across the country, and also that there are a number of significant differences from market to market that aren't actually incorporated in models like that. And so with that as background, perhaps I'll turn it over to Carolyn for an update on how the housing market has evolved and what's our current standing on it.
Sure. Thank you, Governor. Well, we continue to look at the housing market very closely because of the potential financial stability implications. And, what we've seen over the last year is what you would expect given the transformation of the economy going from more energy-based to non-commodity based. And you noted quite rightly that energy places that are dependent more on energy, not only Alberta but other provinces, you see their housing market conditions slowing quite considerably. And it's what you would expect as people become unemployed, perhaps move to other provinces to find new employment, or just go home to where they originally worked before they moved to Alberta. So there's a lot of that going on, and you see the slowing there. Now, if you look at elsewhere in the country, there's just kind of two other things going on. You've got major cities like Vancouver, the Greater Toronto area, where the markets are actually going very strongly, and we're watching that closely. I mean, the context there is that how strong that is just a function of the supply-demand dynamics that have been going on for years. But adding to that, the interprovincial migration of people, and also the fact that their employment's up and their economies are just doing relatively better than the energy-dependent places. And I think when you look at that and try to make an assessment of the market, you really need to take into account those supply and demand dynamics. And Vancouver and Toronto, it's well known that the supply constraints, just because of geographically, because of the permits, and because of the interest people have in working and living there. So clearly, from a monetary policy point of view, it's something that we look at and we take into account. At the same time, given the localized nature of the things that we're really focusing on right now, monetary policy as a tool really is just too blunt for that. Really, there are other tools, and as you know well, the government has taken some actions recently that just came into force, and so we'll be watching it closely.
Thank you.
Thank you all three. Mr. Caron.
Welcome, Governor, Ms. Wilkins. In previous Parliament, we had lots of interesting exchanges on the needs to include or not include some tools in the toolbox of the bank. At some point, we were talking about quantitative easing. More recently, last year, you commented on the possibility or your openness to actually consider negative interest rates. Some countries are actually experiencing or experimenting with this, including Sweden, Japan, Denmark, the Eurozone as well. There seems to be a growing consensus, and I'll ask you to comment on your evaluation of the experiment so far. The consensus I'm seeing is that short term, it might actually provide the help that's needed and that's looked for, but midterm, we're losing that efficiency, there isn't that adaptation to that reality that actually brings about a loss of the efficiency in stimulating the economies and really trying to get the investments needed. Can you comment on this, on what you're seeing so far?
Certainly. Yes, in terms of the toolbox that you referred to, our toolbox was laid out back in the midst of the crisis in 2008. And so last fall, we undertook a project to update it in light of experience since that time. Most of the experience that we referred to, happily, was not in Canada, but was in other countries where the problems have been more serious. But in the institutional context we now believe that our markets would continue to function more or less normally at interest rates as low as minus 0.5%, whereas we used to think of 0 or 0.25 actually, to be specific, as the actual physical lower bound. That means that we have on the order of 75 basis points more room to maneuver, as you suggest, for relatively short-term issues. It's true that the distortions that may emerge grow with the length of time that is there, and possibly the effectiveness of this policy would diminish if it were for a longer time period. And so it's in that context, though, that we think of quantitative easing, which we've had some very interesting uses of quantitative easing, which have had a significant impact on performance in various economies. And so we don't say concretely which of those tools we would appeal to if the situation arose. We just start with saying that fortunately our outlook is that none of that is necessary, that our outlook is quite a positive one. But if there were a significant negative shock to the economy, we know we have a toolkit available to help buffer the effects of those things. And what order we might use those things in, or in which combination, would depend on the circumstances and what seemed best at the time.
Speaking still about that toolbox, I remember comments that you made once again in the last Parliament about the fact that we are in a new normal right now with lower economic growth. You're currently negotiating with the Department of Finance for a new or a renewal of the inflation target, which comes to an end by the end of November. That inflation target has always been at 2%, plus or minus 1, of course. But that was set back in the 90s. At the time, I would submit that it was a different normal than what we're experiencing. Is there an evaluation that's being made, and I've seen documents that the bank has released, but it's been a while ago, on the possibility of actually giving the bank more flexibility by adjusting the target, at least for the next 5 years, maybe to a higher level? So that you would actually have more flexibility in the establishment of the nominal interest rate and more influence in terms of the real interest rate.
Yes, that's a live issue for us at this time. I won't go into the conclusions of that work, but some of the working papers have already been published. So there are 3 issues that we've set out to need to be addressed at this time before we renew that agreement. The first is, what's the right measure for inflation? Should we change from the CPI that we've used traditionally? Secondly, what is the level, which is the question you've just raised, 2% or some other number? And the third is, how do we integrate financial stability issues into that policy framework? But the one about the level is perhaps the most prominent issue, and it's because of the experience of the last few years when central banks, including ourselves, got to the lower bound. And if interest rates had been 1 percentage point higher when it all started, you would have more room to maneuver. However, so that's an important consideration. That experience has, of course, been historically quite rare, but now it has happened, so one has to think about it. The other side of that discussion is that now that we understand that negative interest rates are possible, that also gives us more room to maneuver than we thought we had before. So that's that 2 sides of the coin which need to be assessed, and what are the relative costs and benefits about that extra flexibility. What would it buy us? That's the question, especially when we have unconventional tools in the toolbox that can be used if need be. So it's a live question still. We're just at the stage where we begin concrete discussions with the Department of Finance in the next month or 2.
Okay.
Go ahead.
Do you believe, and I know you don't comment on fiscal policy, which I agree with, but we are doing work here which is being listened to by the Minister of Finance, or so we hope. Do you think it would be relevant for this committee to actually study the possible impacts of modifying that target inflation for advice maybe to the Finance Department?
Well,
is it a lively debate right now that should be taking place?
We would welcome further input on that question. We've had various academic studies and so on that have been prepared. So we've had a lot of input on that. I would just say, for me, the bar for changing this framework is very high. It has performed very well for Canada for 25 years now. So we won't take it lightly, this question. But of course, any further input, which the Finance Minister would want to take into account, would be very welcome.
To both, Mr. McKinnon, 7 minutes, please.
Merci. Merci, Monsieur le Président, Monsieur le Gouverneur.
Thank you, Mr. Chair, Madam Wilkins, Mr. Governor. Thank you for your detailed report. I want to come back to a world scale. The report raises challenges that we are facing throughout the world, which Canada is facing. You've come from the International Monetary Fund meetings where there were discussions about macroeconomic trends. I'm hoping that you could perhaps offer some comments about the conclusions of those meetings. And I also noted that there's almost a tone of relief in your report when it comes to the Government of Canada's efforts to invest in Canada's economy. In a global context, could you comment on what you've observed in other countries when it comes to their attitudes towards public investment as a generator of economic activity?
Oui. Oui, on commence avec
Yes, we're starting with the recent meetings of the International Monetary Fund. The forecasts for world growth increased slightly. There's a matter of modest acceleration of growth, but we observed a certain amount of discouraging activity over the last few years and a lack of performance noted generally. If we look at individual countries, recent focus was on China. China today is an engine for growth for the entire world. China has noted changes in their economic drivers. This is an important and essential transition. The previous situation was not sustainable. In this context, as well as difficulties with other countries, we've noted those difficulties are continuing in other countries. For example, in Europe, growth is weak, but there were some encouraging signs. We saw some progress due to monetary policy and public investment. We noticed investment in infrastructure programs. Even in the United States, who has solid results right now, even in the United States, monetary policy has changed towards economic drivers through their highway bill. That's an important element of infrastructure that's being added. That's why all these little stories from various countries are encouraging to me. I'm seeing that there is a trend towards improvement. Thank you very much. What I'm understanding, based on your response, is that it's time to invest in renewed infrastructure and strategic infrastructure in order to get our economy going again. Our committee will be seized with the issue of growth. We are experiencing a period of anemic economic growth, as you have observed. We were asking ourselves, I was asking myself, if you had considered potential breaks to growth that you're observing in Canada's economy, in its structure, in the regulation of Canada's economy. Are there issues or particular items that are obvious to you as potential breaks to economic growth in Canada, things that perhaps we could deal with that would free Canada's economy to a certain extent in order to improve its anemic economic growth? Well, to start, there are breaks. There are categories of breaks. There are natural and unnatural breaks. A natural break is demographic growth. We're noticing the demographic trend among baby boomers, 40 to 50 years old. Many individuals will be taking their retirement. And there is a potential growth rate that we've observed throughout the world, estimated at 3.25%. Instead of observing a growth of 4%. That's a significant slowdown. In Canada, 1.5% potential growth. What are we going to do to increase that? Well, there are examples of unnatural breaks. For example, free trade agreements, domestic trade, trade with other countries, regulation. At the G20, we had to establish government priorities. Structural reform seemed to be the most important. That figured among the list of items that countries indicated could free economic growth. If we increase growth by 0.1 or 0.2%, that doesn't seem like a lot, but it is significant over the long term. Would you like to add anything? You've explained everything very well. I would only add that in a world where Canada has an economy that is not favoring growth right now, productivity becomes very important. At the same time, in Canada, what is very unique is the transition that we're in right now. We're in a restructuring phase because part of the economy, the energy economy, is diminishing. But we're trying to transfer all those resources, labor, capital, towards parts of Canada, parts of the Canadian economy that are going to grow. All of those things will help to create businesses and in order to improve mobility of labor. Those are important elements right now. Do I have more time?
Mr. Albas, 5 minutes, if you could.
Je vous remercie, Monsieur le Président.
I would like to thank you, Mr. Chair. Mr. Chairman, I was glad to hear you talk about economic growth and free trade.
About in the media last week about the your concerns about perspectives in the public sphere around free trade. Could you elaborate a little bit about that and what that might mean if other countries and particularly Canadians start to look more negatively in that area? What that might mean to economic growth prospects for Canada?
Well, Canada has always been and always will be highly dependent on international trade. In relative terms, we are a small country and can't sustain our standard of living without being able to tap into foreign markets in one way or another. And so anything which puts that at risk would be something we'd need to take very seriously. Of course, perhaps the way I think of it is the best defense is a good offense, which is to say that aggressively pursuing trade agreements with all comers, all those who are interested, either at the multilateral level, which is a very difficult process, but having that energy always there, but also pursuing bilateral arrangements, which just simply adds to the momentum, if you like, through the back door, is something that we're likely to benefit disproportionately from. And the bigger the country that we're dealing with, the more the benefits favor the smaller country.
And when we discuss terms like the Trans-Pacific Partnership, obviously the province of British Columbia, which my riding is in, the Premier has come up in very fierce support of the Trans-Pacific Partnership. Yes. I also note that I believe in your report, both in terms of job growth and economic growth, British Columbia is set to lead Canada as a province. Do you think that aggressive path, because we have been part of the TPP, do you think arrangements like that should be where we should be focused on?
Well, I do, and the comments that you referred to from the weekend were around if those possibilities are somehow in doubt or under threat from others, it is our duty as policymakers to explain them to people as best we can, so that they have a clear understanding of what is at issue, rather than something that may be motivated by something more political or partisan, if you like, in certain settings. So And I think that economists understand free trade so well that they're they treat it too simply, that of course it's good. But that sounds, to those who have to go through the adjustment, it of course sounds like they don't understand the situation on the ground. So we know that when we liberalize trade, there are people whose lives change as a result, some positively and others negatively, but that the entire nation benefits. And so it's that second part which often is lost in those discussions. So that our income growth, which allows us to provide cushions and safety nets and so on to help the transition, just as we're doing at the moment to help the transition from the energy sector to the rest of the economy.
Un autre sujet c'est grande importance pour moi is free trade within provinces, internal trade. Again, there's been a variety of different reports over the past several years. Groups like the Canadian Chamber of Commerce have been, I think since the Chrétien government signed the original agreement on internal trade in 1994, have been asking for a more comprehensive agreement. Is there potential, particularly given light that we are seeing so much foreign direct investment washing out of Canada, where it would be an opportunity for domestic producers to scale up, grow their exports to other provinces, and thus our economy?
Well, I haven't studied the exact question you're asking, but as a principle, the kinds of interprovincial trade barriers are exactly, the other member was talking about, barriers to growth of some form or another. But as with all things, they help some people while hurting other people. So changing those things is always a certain amount of angst around those things. And I just think that the important principle to bear in mind is that if it's good for the economy as a whole, there is room to maneuver around cushioning the blow for those who are affected negatively. And that's just an important ingredient that is often forgotten.
Merci.
Both turning to Mr. Greywall, 5 minutes.
Thank you, Mr. Chair, and thank you, Governor and Deputy Governor, for your testimony today. I'm just going to comment on the report a little bit. It says on the Canadian economy that the projection for economic activity through 2016 and 2017 has been revised up. Slower foreign demand growth, the higher Canadian dollar, and a downward revision to business investment all had negative impacts on the outlook, but are more than offset by the positive effects of the fiscal measures announced in the federal budget. So I'm going to focus on the Canada-US exchange rate. Now, I won't ask what the ideal exchange rate is because that is determined by the market, but can you comment on if the exchange rate, the Canadian dollar is low, what are the negative effects to the Canadian economy? And if the Canadian dollar is above the US, what are the negative and positive effects in both scenarios?
Okay, so we think of the Canadian dollar as a general equilibrium variable, and I know that sounds like a technical thing, but what I mean is that virtually everything that's going on in the world economy or in our economy has some feedback effect on the currency, and it's why it's never simplified in the way you describe. So oil prices, say, go down, that causes the Canadian dollar to go down. Oh, does that mean the Canadian dollar didn't go down by itself? So there's two things happening at the same time. So we know that lower oil prices are unambiguously a negative for the Canadian economy. The decline in the Canadian dollar helps to cushion that blow, but in the end we still have a negative for the Canadian economy. So usually when people ask questions like that, they think about, well, if the exchange rate moves all by itself, is that good or is it bad? And it's always a dual-edged sword, because for somebody it's good, and for somebody else it's bad. And so it's best not to really think of it that way. It's more like its usefulness as a thing to keep things moving where they belong. And as you say, markets decide that the best. So when the dollar is on a weak side, it's promoting exports of companies for which that matters. There's some that have a lot of imported inputs that it matters less. For those who are thinking of investing, the capital equipment may be an imported machine, so it would cost them more. So The lower dollar causes them to slow down that decision, which would be good for economic growth if they did it, while at the same time speeding up demand for their products, which is obviously good. And so for every company, it's different. And then, of course, there's the households, because the price for your imports, whether it's a vacation outside of Canada or if it's simply fruits and vegetables, varies according to the exchange rate. So an extremely complex question, and I hope you'll forgive me for not giving you a simple bottom line.
I appreciate that, your comment. Moving on to a comment my colleague made, and I'm wearing my nonpartisan turban today to show that in an act of good faith to Ms. Riyad. Historically, what has the multiplier been? So she commented on that a lot of the tax cut measures in the budget may not be spent into the economy because of high levels of household debt. And now we're making an assumption, which is every financial forecast has an assumption, whether you're forecasting at a private company or you're forecasting, in our terms, the Canadian economy in the budget. But historically, what has it been? So if the government implements a tax cut, how much of that money is seen to trickle in to the economy?
Just 1 second. This point's wrong.
Naturally.
So as the governor said earlier, the multipliers for the tax cut are a bit smaller than the multipliers you would see from another type of government expenditure. If you can look at it a whole pile of ways. So all I can give you is a range. If you look at the literature, or you look at the models that the Bank of Canada has themselves, there's a number of them that you can look up. Historically, in the first year, the range is 0.1 to 0.4 percentage points, and 0.1 to 0.6 percentage points in the second year. That's the range. Now, of course, those ranges don't take into account, they're coming from the literature, they're coming from models that talk about tax cuts that are very broad, right? And if the tax cuts are in particular to a group of households that tend to spend more out of their income, so modest and lower income households, you would expect the multipliers to be higher.
Thank you, Governor. Thank you, Deputy Governor.
Cut you there, Mr. Greywall. Mr. Leipert, 5 minutes.
Thank you, Mr. Chair. I've got 3 fairly quick questions, I think, and then if there's a bit of time left, my colleague would have a very brief question. First of all, thank you both for being here. In the budget, we've heard a lot about the jobs, the numbers of jobs that would be created. It's certainly been challenged, I think, in some respects. I was curious relative to your report contained no job figures, so I just want to ask if you did an analysis, if you did not, can you explain why? And if you did an analysis, why there are no job numbers in your report?
Yeah. Okay, so, well, it's really, the real question is, what is it we need to do monetary policy? That's what the monetary policy report is, our key tool. And so it's for us, what we do is we translate those shocks, such as the oil price shock or such as the fiscal changes, into the implications for economic growth. That economic growth then is combined with our estimates of how much potential growth there is in the economy to determine what inflation will do as a result of those changes. And that then gives us the full policy discussion. So for us, it's not, although it's interesting, it's not a key factor, how many jobs are being created. Now, the potential output thing that we talked about has a clear labor market connection, which is that output comes from people working with and the productivity that they generate. So as all the adjustments in the economy work their way through, we have a convergence on the economy operating at full capacity and the labor market operating at full capacity also. And that creates jobs, of course, along the way.
Okay. In the past, you've been quite outspoken relative to the jobs being created by the private sector. This budget talks a lot about government creating jobs. I'd just like to hear a little bit more about, obviously, we would have liked to have seen incentives that would have had the private sector create jobs, because I think we all recognize that that's not a strength of government. I'd just like to know if you have any comments relative to that, what kind of things might have been in the budget that would have incented the private sector more than it did.
Well, I think it's not for me to comment on the actual policies that were embedded in the budget. For us, as I mentioned a moment ago, what we need to understand is what will be the change in aggregate demand in the economy as a result of the budget. And that then, therefore, is just one ingredient that we must consider along with exports, investment, and all those things. And so whether a different budget or different details would give you something different, long run or short run, is really not our purview.
Okay, did you take into account in your assessment any form of carbon tax? I know, as an example, there's a carbon tax coming in Alberta in 2017. I think there are some various other provincial initiatives.
CPI, right.
We're sort of expecting something from our friends across the way in the next, within this term. In your out-year projections, was carbon tax factored into that at all?
Well, it's something which is beginning to enter, but for us, for the moment, primarily the way it would enter is on our monitoring of inflation. So if you had a tax, for instance, if there were an additional tax in each liter of gasoline that were related to a carbon tax, and that would affect the CPI. It would affect it in a once and for all way, like CPI would go up the day it went in, and so the inflation rate would be higher for 12 months, and then it would fall back out again, just like any other tax change. So we have acknowledged that in our thinking, but it's not an important factor in the underlying inflation story at this stage.
Mr. Ouellette, 5 minutes.
Okay.
We'll get another round.
Thank you very much, Mr. Chair. Thank you very much, Governor, for coming here today. I just have two central questions, and I'd just like to put them in context a little bit. As we all know, the Bank of Canada's mandate and that of the central banks is to keep inflation low. And while the bank has been trying to intervene in the Canadian economy and stimulate borrowing and investments with low interest rates, it's also the case that the bank may intervene in the economy when it appears that the economy is too hot, that is, when employment drops to quote unquote low the end, or when there's a threat that wages might rise and therefore drive up inflation. Now, some Canadians might be surprised by this because they generally think that if the Bank of Canada and the government were going to intervene in the market, it would be to create more jobs with better wages and not deliberately act to increase unemployment and prevent wage increases. Now, an economist, Arthur Okun, who was a member of the President's Economic Advisors, wrote in 1976, "The crusade against inflation demands the sacrifice of output and employment." Joseph Stiglitz, the Nobel Prize-winning economist, has written that a focus on inflation puts the bondholders' interests at center stage. Imagine different monetary policy might have been is the focus has been on keeping unemployment below 5% rather than on keeping the inflation rate below 2%. Now, the Cambridge economist Han Jun Chang has written, lower inflation may mean that what the workers have already earned is better protected, but the policies that are needed to generate this outcome may reduce what they can earn in the future. And why is this? The tight monetary and fiscal policies that are needed to lower inflation, especially to a very low level, are also likely to reduce the level of economic activity, which in turn will lower demand for labor and thus increase unemployment and reduce wages. So a tough control on inflation is a two-edged sword for workers. It protects their existing incomes better, but it reduces their future incomes. It is only the pensioners and others, including significantly the financial industries whose income derives from financial assets with fixed returns, for whom lower inflation is a pure blessing. Since they are outside the labor market, tough macroeconomic policies that lower inflation cannot adversely affect their future employment opportunities and wages, while incomes they have are better protected. Now, it would appear to me that the Bank of Canada's core mandate since the 1970s has been to put a thumb on the scales in the favor of investors, especially established investors, at the expense of everyone in the labor market. The switch to this policy was a turning point in the countries like Canada, the UK, the US, when wages, for the most part, started to stagnate and the incomes of CEOs and investors started to increase. It could be argued that this change marked the end of the era of inclusive growth after the end of the Second World War, where the economy grew. It grew for everyone, and the beginning of a new era where the benefits of economic growth were concentrated now in the hands of a few. Inflation has not been a problem in the economy for decades, and in the 1970s, it was driven by deliberate manipulation of oil markets by OPEC. My question, and I'm sorry, is it a consequence of the Bank of Canada's anti-inflationary policy and low inflation target that you will intervene in the economy to sacrifice workers and wages in order to protect investors, as per your mandate?
The floor is yours.
Thank you.
A lot of background there. Go ahead.
So the choice of inflation targets as a regime for monetary policy in Canada is now quite over 25 years old. It came out of a horrific experience. It grew out of an horrific experience with high inflation. It is unambiguous. It is unambiguously accepted in the economics literature that lower inflation over the last 20 years has led to better economic performance for all participants in the economy, whether they're working, whether they're retired, whether they hope to retire, everybody. So that is unambiguous. In the very fine points, it's many of the points that you've made are what I would call disequilibrium points. That is, they're partial equilibrium. It's true that if this happens, then this happens, but it must be considered in the context of the entire economy and whether the economy has achieved an equilibrium which will stay. And our belief, very, very strongly held, is that the economy does not stop moving until inflation is stable and the rest of the economy has adjusted to that level, and that defines what we call the divine coincidence, where we have maximized employment.
So, Governor, so how would
excuse me.
We're out
Chair?
of time.
But just, Mike, how would the Bank of Canada's policy be different if the focus was on full employment instead of inflation? So if you were focused on employment.
Robert, we're out of time.
Okay.
There'll be an opportunity again. Mr. Caron, 3 minutes, and then Mr. Champagne, and then Ms. Raitt.
Thank you very much. Let me go back on the impact of the deficit spending on infrastructure and tax cuts that have been announced by this government. You stated that there are some times, and this is one, where we have to observe what fiscal policy could actually do rather than monetary policy. On the other side, we'll need to actually see the results of what has been announced, especially in terms of where the money will go, how efficient the investments will be. We know that there is some lag, some time between the investments themselves and the benefits or the impact it will have. My question is, how long are you going to wait to see what results we get from those decisions that are made? The initial assessment of the success, and how long before you make a definite assessment that it had worked or not worked to the extent that we hoped it would?
Well, monetary policy making is fundamentally data dependent, and by that I mean not the individual bits that we refer to, but the entire economy. So now we know that there are fiscal actions being taken. Some of them will happen quickly, some will take longer, but they are happening. So for us now, they're just in the mix. And so we'll watch the economy and see if the economy measures up to our expectations. And as long as it does, then everything's fine. But if there is, for some reason, a shortfall in growth, that will, of course, will mean that it'll postpone our achievement of the inflation target, and we will then have to reconsider whether or not monetary policy requires adjusting. If the opposite occurs, such as an upside surprise, which would be very pleasant for a change, then, of course, we'd have the opposite situation. So that's to say that monetary policy is live throughout that piece, depending on how the data evolve, not the precise individual parts.
I understand, but the way I see it right now is that the bank will take somewhat of the back seat right now to see how this will actually work. But then at some point, you will look at the growth, the impact, the effects it will have. And eventually, you'll have to make an assessment that it worked or not. I understand the need to actually wait for the data. But on the other side, there is an argument to be made that you'll have to, even if the data moves in one direction or the other, the temptation will still be there to see, well, let's wait a little bit more and a little bit more to see if it will impact. The lag might be shorter or longer depending on your assessment. So this is why my question of the timing is actually important. At what point or how much time are you going to give those measures before making or considering getting into play rather than taking the back seat?
So the implication of your question, though, is that monetary policy is conducted very finely as a very almost an engineering exercise, and I would resist that interpretation. It's more a question of what are the risks. So today we have a forecast which includes the fiscal inputs, and if we go 6 months and we're seeing the economy is behaving less well than we thought, then we'll say, well, there's a downside risk there, but don't forget this could happen. Those are just risks. And so, but we have to make our decision every 6 weeks on the basis of what we actually have in front of us and what is our live judgment about how things are unfolding. And we're watching a lot of other moving parts other than just the government spending. In particular, exports are expected to contribute 2/3 of the growth that we're predicting. And so that, of course, is our big preoccupation. Investment spending by firms will be the second thing as that comes in. So all those things have to be analyzed on a continuous basis, and it'll be in the aggregate. And so in that mix, there will be fiscal results. It's very hard to disentangle, if you understand. Thank you.
Very much, and I do have one question as chair. You said earlier that part of the economy, the energy economy, is diminishing, and you said in your report on the Bank of Canada report on April 13th that investment in the energy sector is expected to decline by 60% from 2014 levels. I actually come out of the commodity industry as a former producer, and we see ups and downs, booms and busts, and we see that in the energy sector as well, although there's a lot of global pressure on energy. I'm just wondering, and this may be a controversial question, and it may be something that you don't want to or can't answer, but have you looked at what the investment situation would be if an Energy East pipeline were in place or other pipelines? Yes, there'd be the investment from the development of the putting in place the pipeline itself, but would that have any impact on the oil economy in terms of easier access to market, or in the Energy East case, putting oil into the refinery in Eastern Canada? Do you look at those scenarios? Can you answer, or do you know anyone who does?
Chair, I don't have an answer to that question for you. That's a complicated analysis, better put to people in the industry or associations related thereto. But I mean, right now what we're dealing with is low prices, and I think that's the most important driver here. Low prices for oil mean that the economy has to readapt, and the size of the energy economy will be smaller as a share. That's what we're of the total economy, and that other parts of the economy will grow faster for a period to fill in that space. And that's a process that we expect to take several years to complete. So how a pipeline project may or may not fit into that picture is a very complex analysis that we haven't done.
No problem. I just thought I'd ask it. Don't ask, you don't get any answers. Mr. Champagne, 5 minutes.
Monsieur le gouverneur, merci d'être là, Madame.
Thank you for being here today. In the media, it was indicated that you said that measures contained in the last budget will have a positive impact on Canada's economy. For the benefit of the committee, Could you tell us a bit more about that? And which measures were you referring to, those that would have positive impacts on Canada's economy, not only in the media, but for long-term economic growth in the country? There are two aspects to that question. First of all, if there's a boost to the economy in the short term, and secondly, if the expenditure is an investment in infrastructure, for example, it has the potential of adding a positive trend for growth. Even an increase of 0.1 or 0.2 over the long term could be significant. It's something that's very difficult to estimate, but it is positive if it frees growth.
And I think, is it fair to say that while you were at the, I think it was the G7 or G20 meetings, that a number of economies are looking at Canada in order to look at what Canada's been proposing in terms of restarting growth? I mean, we know Madame Lagarde said, you know, we have this mediocre growth kind of area which we're facing. And a number of nations are looking at things that could be done in order to grow the economy, not just for the immediate term, but the long term. And what are the kind of measures that people were talking about? I know that people have singled out Canada. We saw that on the Wall Street Journal. We saw that in Financial Times, poster child. Can you elaborate a bit on that, what people were sitting around the table, the feeling?
So I won't comment on specifics for other countries, but the general thrust is that there are three fields of policy which should be working together in this situation. Monetary policy is clearly very stimulative globally and is close to its maximum ability. Fiscal policy is less widely engaged, but is in certain places that I mentioned before. But the third, and probably the most important at this stage, is structural changes to the economy, the barriers to growth that we talked about earlier. And the contention of the IMF and of those around the table is that those three can work together. That is, a structural policy on its own may just have some positive effects long term, but if it's and possibly negative effects in the short term. And so using fiscal policy with it to cushion the blow and add some extra impetus to the economy helps offset the negative while ensuring the long-term effects are good. And monetary policy is there to keep the system well prepared for that, to nurture the process. But using just one of them is actually not the recipe. The important thing is to have all three operating. That's the nature of our discussions.
Other question, Chair. I think you mentioned three things which I noted in particular. Talk about innovation, talk about productivity and exports. You know, can you expand a bit on that? The impact of investing in fostering innovation, productivity. I know the productivity gap in Canada compared to the U.S. Measures that you know are helpful when we look at these three components of our economy. What are the possible impact of the economy, positive impact when you invest in these three things? We talk about innovation. You mentioned it, export being fundamental to the Canadian economy, as well as productivity. Can you expand a bit on that?
So any investment which makes it easier for firms to grow is going to add to that productivity line, and every little bit counts and adds up. Secondly, anything you can remove that is an impediment to growth adds to that process. And finally, I think the most important aspect of all is to nurture the process of creation of new companies, because historically it is new companies, young companies, that have had the giant leaps in productivity that have made our aggregate productivity statistics stronger. And that process has been slow since the crisis. In the U.S., it has begun to pick up nicely. In the U.K., it has picked up nicely. We're a little bit behind that process. I'm confident it will happen here too, but it's the most important phase where productivity is fostered. So policies that favor young companies to allow them to grow faster. And there's a wide menu of those, I think, are the main thing that we should focus on.
You
Champagne, Ms. Raitt, 5 minutes.
Thank you, Mr. Chair. Governor, the other aspect of your report from April 13 talks about the economy's potential growth rate, and you downgraded it from 1.8% to 1.5%, which I think is a significant number. I'd like you to comment on that. But secondly, when you say later on in the release that we're going to hit capacity the second half of 2017, does that mean you think you'll be in a position to increase interest rates when the economy comes to full capacity? So the first part is, why the downgrade from 1.8 to 1.5? And the second part, which, by the way, is much lower than our historical cruise rate, to quote Barry McKenna, of 2.0. And what happens in 2017? Are you looking at returning to your normal 2% inflationary rate?
So I'm going to ask Carolyn to address the revision to potential and what that means. I would just say in general terms, potential is a very uncertain concept. So it's not a brick wall somewhere out there. And it can be affected by many of the things that we've talked about in committee today. A lot of things that could mean more potential as the economy reaches its full stride. And that postpones that point where we're going to run out of extra resources, such as 120,000 youth who have withdrawn from the workforce. That's not early retirement. That's a discouraging effect. Bringing them back in will make all the difference. So, Carolyn, why don't you walk through a couple of the numbers?
Sure. The downgrade in potential and the range for potentials, I'd like to emphasize our potential is really in a range, is really reflecting primarily the downgrade that we made to business investment. Because that business investment that we still have in there represents what we call capital deepening, which means that labor productivity improves. And now the downgrade in the investment is primarily in the energy sector. And so it's what I was talking about before, which is we're in this destruction phase, or the phase where the energy sector, the negatives there are really outweighing the positives in the other part of the economy. And so you'll notice that those ranges stay lower for a while, but then start to move back up as that transition progresses. So you'll see productivity, you'll see potential output growth, that range moves up starting in 2018 and going up to 2020, which is the end of our estimate. I think another factor here is just labor. So the more people you have in the labor force, the more you have adding to potential. And so what we've seen is a lot of people were discouraged and out of the labor force. Over the last year, we've seen many prime-age people come back to the labor force. And it's possible that even more will come back, particularly younger people who left the labor force after the crisis and over the last couple of years.
Mr. Elbutov, the rest of the time.
Yeah, thank you. Thanks. I do have one short question. It's a very common question. Where will the government be borrowing money from? And can you brief us on the mechanism behind that too?
So where will the government borrow money from? So, well, the government borrows money on the market, and that's pension plans invest in government bonds, individuals invest in government bonds, foreigners can buy government bonds. So literally everybody, and Canada has a very strong credit rating and big appetite for Canadian debt and a very low level of indebtedness. So it's seen as a very strong credit.
Thank you. Another question. We've seen falling of commodity pricing, which basically stunt the resource investment in Canada at large, and specific in Alberta and other places. That both lead to a lower Canadian dollar. You expect with this scenario to see that the status quo, you'd expect that there will be other investment coming because of the lower dollar, which is we don't see. And that's a puzzling scenario that we haven't, I don't think we have even anticipated. So what measures can we take in generic knowledge that in this case, you have to lower business tax in order to attract investment, which is what the government have proposed is not going to happen from the budget, or unless there's a miracle happens somewhere around the world that is going to really enhance Canadian economy. So would you encourage lowering business taxation across Canada?
Well, I won't comment on a specific fiscal initiative such as that. But I would just say that what we're expecting in our outlook, as outlined in the NPR, is that investment in the non-energy, non-resource part of the economy is primed and ready to pick up strongly. Our surveys tell us that people are almost at capacity, that they need to upgrade their equipment. And the order book is strong from the growing export sales. Therefore, all the ingredients are present for this second half of this year to start stronger investment in the non-resource economy. And I have no doubt that that will be participated in by foreign investors as well. And especially, as you mentioned, with the dollar lower, it makes that sort of investment a stronger value proposition for a foreign investor than it would have been while the dollar was stronger. And so for us, what matters is that the investment happens, new equipment happens, productivity rises, and our capacity increases, and more jobs are created. That's the magic combination that we're forecasting to be picking up speed now. So that's what we'll be watching very closely, and foreign investment will be part of that picture.
Thank you both. We're quite over time there. Mr. Caron and Mr. Sabera will split the remaining time, if we could, between the two of you. Go ahead, Mr. Caron.
Thank you. I do have one question, quick, but the answer might be a bit longer. When we talked about the inflation, target inflation negotiations right now, you said it would take a very high bar to actually change it from the 2%. But you alluded to the fact that right now the definition of that CPI is actually under consideration. Right now, the CPI that's being used by the bank excludes the most volatile elements, which has its advantages and its drawbacks as well. One main drawback that I could see is that in that evaluation, you're basically evaluating the cost of living that is actually not experienced by the average Canadian. My question is, beside the status quo, which is a possibility, what are you exploring in terms of possibilities? What are the options that you're currently looking at? And if you can comment quickly on the benefits and drawbacks of what you're looking at.
Let me just start by saying that the CPI is still the central measure of inflation, as you say. It's the one that captures what everybody buys. And when we're talking about different alternatives, what we're talking about is the operational guide, which tries to see through some of the noise. And so, Carolyn, do you want to talk about the candidates?
Sure. Well, there are a number of different candidates. So we originally chose CPIX because it was a way that the measure of core that we focus on most that excludes the volatile items. And what we've seen over the last couple of years is that the usefulness of this measure as an operational guide, that means we can sort of see through the volatility in the total CPI index and set monetary policy to see through that, so we don't change interest rates for something that will be over by the time it has an effect, right? That's what we're doing. Well, the usefulness of that has declined for a number of reasons, which we've talked about in research that's been published. So we're looking at other measures. Some of them are highly statistical measures that use more complex econometric techniques. We're also looking at measures that basically crop, instead of excluding the same items every time, what they do is they crop off the items that increase the most and those that increase the least in any particular period, and doing statistical tests to see which ones perform the best, and will serve us well. That research is ongoing, but a lot of it's on our website if you want to have a look.
Last question, Mr. Silvera.
How long do I have, Chair?
You have about 3 minutes, no more.
Just a quick question. Governor, you commented on the three tools, if I can call them that: monetary policy, fiscal policy, and structural change. On the fiscal policy side, your estimates from the April monetary policy report, incorporating the budget or the fiscal measures in the budget, was for about 0.5% boost to growth in 16, and which is in line with the Finance Department, and then a 0.6% boost for 17, which is under by 0.4 from the Finance Department's estimate of 1%. So there's a slight change there. But I wanted to comment, touch upon one thing that you had mentioned a few months ago about infrastructure investment being an enabler for long-term economic growth. And you had commented that to the Parliamentary Secretary as well, and how important investment in infrastructure is to enabling long-term economic growth and improving our productivity. And on that vein, in terms of the productivity front, and with reference to your comment on structural changes, what measures or what areas could you see improving the Canadian economy or undertaking in the Canadian economy to deal with the structural changes that you may have mentioned? I know you mentioned free trade. How about, if I can just throw out, if you wanted to comment, not on specifics, the efficacy of our tax system and so forth. Thank you.
Okay, well, I'll be brief, Chair. That could keep us busy for quite a while. But just to begin with a factual, the estimates that you referred to of the effect of the budget on the outlook are on growth rates, whereas the effect that was described in the budget and in the footnote, I think footnote 8, or anyway, somewhere around there, that in the NPR, is that the effect on the level of GDP is 0.5 the first year and 1 percentage point the second year. So in growth rate terms, it's roughly 0.5 and then another 0.5. So that reconciles the numbers that you discussed, that they are all the same. It says level versus growth rates. Second, then, I have talked previously about infrastructure as an enabler of growth. To me, infrastructure can be kind of a fluid concept. I guess it's any kind of investment that can be linked to future potential economic growth. So there's a wide range of examples that, from the most obvious, things like transportation, like bridges or high-speed trains or, rail or airport investments, or down, daycare facilities, which enable parents to re-engage in the workforce, which gives us more potential. All those kinds of things are investments that can add to our potential growth and therefore good things. In terms of the third leg of the stool, which is structural reforms, things like that promote labor market mobility between provinces, that relates to interprovincial trade. So the labor mobility is not perfect, nor is it necessarily actually helped. Okay, there are policies that could make it move faster when we're trying to adjust to things. And of course, more generally, as we discussed earlier, interprovincial free trade would help our economy adjust and perform much more efficiently. Those are just some ideas, Chair. There are lots of those.
Thank you very much. We'll have to end it there. On behalf of the committee, Governor, Deputy Governor, thank you for your presentation, but beyond, and your answers to questions. But beyond that, thank you as well for what you do in terms of the stability of the Canadian economy in terms of monetary policy. So thank you once again. We'll suspend for about 3 or 4 minutes while the Parliamentary Budget Officer comes forward. To order, and we're really doing during this session we'll be doing basically two studies or two orders of reference with the Parliamentary Budget Officer. We'll break into two sessions. The first one we'll deal with the Understanding Order 108-2, Study on Economic and Fiscal Outlook. And in the second half of this session with the Parliamentary Budget Officers, we will shift to Bill C2, an act to amend the Income Tax Act, and comments from the Parliamentary Budget Officer and staff in that area. I understand, Mr. Fichette, you have one opening statement that will cover the two. So to introduce who's at the table, Parliamentary Budget Officer Jean-Denis Fichette, Mr. Ascara, who's Assistant Parliamentary Budget Officer, Mr. Mathieu, I believe, Senior Director, Economic and Fiscal Analyst and Forecasting, and Mr. Cameron, Economic Advisor, Analyst, Economic and Fiscal Analysis, and Mr. Jacques, Director, Economic and Fiscal Analysis. Mr. Fichette, the floor is yours. A long time since we used to work at the Agriculture Committee together.
Thank you, Mr. Chair. It's the first time you called me Monsieur Fréchette, so I'm really happy with that. Monsieur le Président, Messieurs les vice.
Mr. Chair, Vice Chairs, ladies and gentlemen, members of the committee, thank you again for the invitation to appear and discuss our April 2016 Economic and Fiscal Outlook published this morning. Today, as you mentioned, I'm joined by several members of my team who will be happy to answer your questions.
Report. The outlook for the global economy has deteriorated further, and commodity prices over the medium term have been revised lower. Despite this weaker external outlook, We anticipate that the combination of fiscal measures in Budget 2016 and accommodative monetary policy will help bolster the Canadian economy. We project that growth in real GDP will rebound to 1.8% in 2016 and then rise to 2.5% in 2017. Growth in the economy is then expected to moderate over 2018 to 2020, reflecting the tapering of fiscal measures and the normalization of the monetary policy. The level of nominal GDP, which is the broadest single measure of the tax base, is projected to be almost $20 billion lower each year on average between 2016 and 2020, compared to our November report. However, relative to the government's planning assumptions for nominal GDP in Budget 2016, our projection is, on average, $40 billion higher per year over 2016 to 2020. The difference is most pronounced in 2016 and 2017, reaching close to $50 billion in those years. Our November 2015 fiscal outlook provided an independent statu quo planning assumption for the start of this 42nd Parliament. We have updated our fiscal outlook to include measures announced in Budget 2016, as well as measures announced prior to the budget. Nous estimons qu'un léger
We estimate that there was a small surplus in 2015-16 and forecast a budgetary deficit of $20.5 billion in 2016-2017, which is mostly attributable to the introduction of measures since the government's fall update. The deficit is then projected to rise to $24.2 billion in 2017-2018 as a result of moving to the 7-year break-even mechanism for EI premium rates, as well as increases in direct program expenses. Over the remainder of the planning horizon, we project the deficit to decline to $12.5 billion based on the government's forecast that direct program expenditures, in particular the operating costs of departments, will remain flat over the period of 2017-2018 to 2019-2020. Compared to Budget 2016, our outlook for budgetary deficits over 2016-17 to 2020-21 is $4.5 billion lower on average. The average difference is roughly in line with $6 billion fiscal impact of the government's adjustment to the private sector forecast of nominal GDP.
Highlights the government's commitment to returning to balanced budgets and to reducing the federal debt to GDP ratio to a lower level by 2020-2021. To provide a broader perspective on the sustainability of the government's finances, we have extended our projection beyond 2020-2021 to show the long-term trajectory of federal debt relative to GDP. Our projection shows the federal debt to GDP ratio declining continuously over the next several decades under current policy. This indicates that the federal fiscal structure underlying Budget 2016 is sustainable over the long term. Monsieur le Président,
Mr. Chair, my colleagues and I would be happy to answer any questions you may have regarding our economic and fiscal outlook or any other relevant matter, such as Bill C-2.
And our current and future mandate. Thank you, Mr. Chair.
Thank you. If we could, committee, though, we would like to keep the first session because I think you have different people to come to the fore for the C2. So if we could keep this first round for about 40 minutes or there, about 35 minutes, to the economic and fiscal update. Mr. McKinnon, 7 minutes.
Fréchette, à vous et votre personnel, merci.
Thank you, Mr. Fréchette, and thank you to your staff for being here today. Thank you for your diligence and your constant support to members of Parliament. I think that the quality of your work goes beyond a shadow of a doubt, and we very much appreciate your efforts. On behalf of parliamentarians and all Canadians, you've become essential to our analyses. Obviously, the $64,000 question, we're going to ask it right away. There's a difference between your analysis and the analysis of budgetary multipliers between you and the Department of Finance and the Bank of Canada, who agree with the Department of Finance's projections when it comes to budgetary multipliers and the impact that various measures will have, measures taken by our government and their effect on Canada's economy. I will give you free rein to comment on that matter.
Merci. Oui, il y a toujours des différences.
Thank you. Yes, there are differences between multipliers and different models. There are multipliers that are less elevated than the Department of Finance's multipliers. The Bank of Canada indicated that they're going to use the Department of Finance's multipliers. So, of course, yes, there are differences between the levels of multipliers and their impact on the economy. My question was more along the lines of how would you explain the difference between your evaluation of those multipliers and that of the Department of Finance? How do you explain that divergence when it comes to the impact of budgetary measures? We use different economic models. Every economist uses different economic models. The hypotheses are different. Usually, there's a difference between different multipliers according to the model used. There's not really a precise explanation for that. Really, it's just a use of different models. But in every model, there are variables. Are there variables in your model, in your analysis, that would underestimate or overestimate compared to models used by others that would perhaps overestimate the impact of budgetary measures? I'm just trying to really understand where the differences lie. If you will allow, often in the models that we use, and eventually I will give the floor to Chris, who will give you all the details on that. The use of models and multipliers is more a matter of judgment than detail. It's the same thing for our projections or our outlooks. When we have different models compared to the Department of Finance. That being said, they have more staff, they have more models, they're more sophisticated than ours, and Chris can give you the details on that.
The detailed results from the Department of Finance, but we suspect that there are differences in terms of the leakages in the economy. That is to say, when there is an increase in aggregate demand, that can be met in several ways, through increased imports into the economy, a drawdown in inventory stocks, or increased production. As well, if you're looking at from the household perspective, increases in disposable income through, let's say, lower taxes, that increase could either flow through into increased household savings or increased household consumption. So the models will differ in terms of their sensitivities in these, to these leakages. As well, I think it would be helpful to have or to see the Bank of Canada's more detailed analysis to which the Governor referred to today. While they do say that they believe the estimates to be reasonable, and I think our estimates in terms of the impacts on real GDP, in terms of the multipliers, are fairly close to the department's. In the first year, anyway, they're identical, and in year two, we're talking about an impact of 0.8 versus 1%. There are some differences on employment, and again, the sensitivity to how the labor market responds to changes in aggregate demand and output will also be affected. But I think in terms of this debate, as an economist, it's fascinating. I think it would be a very helpful contribution to see the Bank of Canada's detailed results as well as their lit review on this. Thank you.
Merci beaucoup.
Thank you very much. Now, where there does not seem to be any divergence, no ambiguity, investments on various levels, notably in infrastructure, are considered good for our growth and will contribute to Canada's growth and will ensure that Canada's economy will perform better than without those investments. Can you confirm that? Yes, I can confirm that. It was also noted in our report on page 2 in the French report, where we indicated that the increase is attributable to the investments that are being made. In our projections, we're a little more optimistic than the department. Perhaps not for jobs, but for growth, certainly. I'm happy to hear it, Mr. Fréchette. With the little time that I believe I have left, I would like to come back to the issue of being careful. The previous government did not use prudence in this budget to the same extent that perhaps Mr. Martin did in the 90s or the 2000s. The Chrétien government, the Martin government. Our Minister of Finance wants to come back to the precautionary principle. You've been clear that you think that perhaps there was a bit too much precaution when it came to growth and that economic perspectives for the country were underestimated. I would maintain that exerting prudence when it comes to budgetary forecasts is essential. Could you comment our return to the precautionary principle when it comes to fiscal outlooks compared to the previous government and how you evaluate that situation? I will not comment on the previous government, but I will say that what we concluded in our report is that, yes, indeed, it's good to exert a certain amount of caution, but too much caution is not a good thing either, because it can create expectations or it can create a certain long-term perspective that can be as deleterious as not having any expectations at all. That's the message we're sending. Yes, it's important to be careful, but being excessively careful is not a good thing either. The measures that we have seem to reflect a normal level of caution. And so the results that we have in terms of projected growth versus the deficit indicate that our growth projections indicate about a $6 billion difference compared to the department's projections. That's due essentially to being overly cautious.
Over. Lisa Ray.
New chair. Welcome. Thank you very much for being here. And I hope I'm sorry, I'm going to do this, but I'm noting I'm the only woman at the table, and I'm hoping that the next round of people coming to the table, you're going to have a woman with you. I'm seeing nodding. Okay, I'm going to take it. And next time you come to committee, you know what you got to do. You got to find them, bring them in.
You'll see the next part of the meeting today.
Bon, merci. Actually, I'm going to take you, if I may, to the statement that you, just for ease of reference, I'm going to ask you about your economic and fiscal outlook that was published this morning, specifically in your appendix F. I wanted to get some clarification and clarity on your fiscal and outlook comparisons. So what we see in front of us there is the PBO and Budget 2016 fiscal outlook comparison, taking your and the budget and putting them together, and you end up with a delta. With respect to the personal income tax, I'm going to ask about 3 areas: personal income tax and children's benefits and then I'm going to talk about public debt charges. I'm wondering if you can give me some perspective about why you diverged from the budget in terms of how much personal income taxes the government will be collecting over the next couple of years. And I do note it's a significant, see, I'm even choking on the words. It's a significant increase in personal income tax collection from $135 million to $177 million, a significant increase in income taxes. But yours is even higher. I'm wondering if you can comment on that, please.
I will ask Scott Cameron to answer your question.
Merci.
He has 40 seconds. Somebody else will provide more information
Okay.
after that.
Thank you.
I mean, that should just largely reflect the different nominal GDP bases, and within nominal GDP, the different shares accruing to households versus firms. The difference between us, the delta between us and finance, would probably be attributable to their risk adjustment, which is spread proportionally over tax revenues. So across those tax categories, you have to lose $6 billion from somewhere. And we're not sure exactly, but they've mentioned in the past that it's proportionally across. So the about $1 billion difference over the 5 years would be what you'd expect from that risk adjustment or forecast adjustment that finance does. So ours is an unadjusted economic forecast underlying the fiscal.
Okay, thank you. In terms of the children's benefits, again, we see a divergence where you do have children's benefits, if I take a look at it, increasing as you go through to 2020, 2021. But yours is actually lower than what's anticipated in the budget.
Because this is quite a new program, we don't have any historical data to work with yet, and we have a very limited subset of tax forms and CRA data that we work with compared to the Department of Finance. So I would attribute most of those differences just to we don't really know what we're working with yet in terms of actual households, income distributions, how the take-up will be amongst the different income brackets. And so I think we're within a very small range, basically, of the difference between us and finance. I mean, I don't know the exact percentage, but it's fairly close, I would say, given it's a $22 billion program. I think being within 300 or 400 million is pretty, I would say we're roughly the same as finance.
In the public debt charges, what is the interest rate assumption that you applied?
I can give you the Table A Appendix A rather on page 18.
Yeah.
We have the outlook there for the 3-month Treasury rate and the 10-year government bond rate. We have an equation that maps those two bond, what do you call it? The duration of the bonds onto our effective rate that we apply to the government debt.
Right.
So we look at borrowing in the market and how the kind of effective balance between those short and long-term bonds maps into the rate that the government ends up paying on their debt.
Right, because the Library of Parliament kindly provided some preparation materials for today, and in it, they indicate that a sustained 1 point percentage increase in interest rates increases public debt. And I'm wondering, since we had the governor in this morning and he talked about us returning to economic capacity in 2017, which one would assume could include an increase in the Bank of Canada interest rate, was that taken into account in this?
Chris will be able to tell you the exact kind of path of policy rate that we assume, but that would certainly we have the effective interest rate on government debt increasing over the outlook.
Sure. Our assumption is that the Bank of Canada doesn't start increasing interest rates until the end of 2017. And I think this would be consistent with the sort of the accommodation of fiscal policy. And if the Bank of Canada had used, well, they've used the Department of Finance's estimates of the economic impacts on the economy, those estimates are based on the assumption that interest rates don't change. So perhaps implicitly that is also the assumption underlying the monetary policy report, but we don't know that for certain.
Last thing, you've done a costing of how much changing the policy on old age security is going to be costing in the future. Can you give us an insight into what that is?
So in terms of its overall sustainability picture, which is that's kind of how we like to evaluate the overall impact of these policy changes. And so the government debt path was sustainable before the change, and it continues to be sustainable after. So the cost in the first full year of the program, 2029, I think we had at $11.2 billion, but as a share of GDP, that's only about 0.35%, and that is the most costly it ever gets, because after that we start to see the demographics move in such a way that, and the parameters of the program in such a way that the cost declined very quickly from about 0.35 to 0.2, down to even as low as 0.18, I think. I don't have it up in front of me, but you see kind of a downward path, and that's partly leads to that graph we have towards the end of the report where you see the debt declining over time. The way that the demographics and program costs move are such that you start to get quite a quick fiscal consolidation once we get over those humps in the demographics. So.
Okay, and in terms of direct program spending, done? Okay,
you're done.
Thank you. Saved by the
Schroll.
bell.
Merci. Et merci à vous tous.
Thank you to all of you, not only for your presence here today, but for the extremely useful work. The extremely useful work that you do. I would like to start with a few quick remarks in order to respond to Mr. McKinnon's statements. The way we approach budgetary policy, the way budgets are created now, I would say that it's Paul Martin 2.0. And that's where we can agree. Yes, it reminds me of budgets tabled by the former Minister of Finance. The difference is, and we're not talking about caution here, we're talking about extremely far projections. Your work is very useful here. And I would say that Paul Martin had deficit projections that were caused by exaggerated inflation of tax credits and revenues that the government gained through financial measures. Here, we're proceeding differently, and we change the estimates accordingly. When it came to nominal GDP, we're talking about a difference of 40 billion a year, even 50 billion a year for 2016-17. We're not talking about caution anymore. I think what we're talking about now, and it's my personal opinion, we're talking about a deliberate strategy to change people's expectations and say that we're going to have a very large deficit and we'll have to be careful with what we do. And in the end, at the end of the year, we'll have a result that will be much better than what was put forward originally, which will cause a certain amount of relief and make the government look good. In one case, like the other, when one is not careful enough, it's a problem. When one is excessively cautious, it's a deliberate political strategy. I'm not asking you to comment on that. I understand your role. What I would like to know is, first of all, you have contacts in the Department of Finance. Where does this extremely conservative projection come from when it comes to nominal GDP? And the other question is, when we have a contingency fund, before it used to be $3 billion, it diminished to $1 billion, and now it's going up to $6 billion. According to your conversations and the information that you received for your analyses, where do these numbers come from? I had the opportunity to ask Mr. Morneau, the Department of Finance, and I never got an answer. The numbers just seem to come from nowhere at all. Thank you for that question. I will give the floor to one of my colleagues, but first of all, what you have said, we never indicated that it was a deliberate strategy. I understand your situation. What I said before is that, yes, this can create expectations. And it's clear that if one is excessive in terms of projected growth, it being lower over the next 5 years, there are certain expectations that are created. It creates a downward pressure on expectations. When it comes to contacts or information that we obtain, 2 weeks ago, not long after the budget was tabled, we published a table that was interesting where we illustrated how the private sector was conducting projections of nominal GDP over 5 years, and then there was a great deal of confusion between over or underestimating those numbers. Over years 1 and 2, their projections seem to be underestimated 60% of the time. That's something to take into consideration. And I will ask my colleague to continue. Thank you. We don't really know why the Department of Finance decided to choose the $40 billion adjustment. But governments for the last 20 years have been using private sector forecasts, and that introduced a certain amount of independence in financial forecasts. But when it comes to making a significant adjustment, the element of independence disappears. It disappears completely. Furthermore, when we change a variable with the nominal GDP, other variables that depend on the private sector forecast become inconsistent with the projected GDP. Thank you. I'll probably come back to that. I think I'll have the opportunity to participate in a second round of questioning. You mentioned, now when it comes to the issue of transparency, what I was talking about when it comes to where do those numbers come from, where do the parameters come used by the Department of Finance, we don't know. So that's an issue of transparency, and eventually it'll be an issue of accountability. Now, I need to raise another issue of transparency or lack thereof. I need to know if you are satisfied with the answer provided by the Department of Finance following the complaint that you made of not having all the numbers you needed. The second point, bringing the forecast from 5 to 2 years and the impact that that changed forecast is going to have not only on developing budgets but on your work as Parliamentary Budget Officer. Thank you for the question. When it comes to transparency, that's a great question, and I would like to take 30 seconds to explain the situation of transparency and what we went through during that period. When we saw that in the budget there were only 2 years planned and not the usual 5 years, relatively traditional 5 years, we were surprised because we did not know that that was going to happen. It was a good surprise because when we asked for the numbers, we obtained the 5-year numbers, or rather the numbers over 5 years. I would say that there's more transparency than before. Third surprise, when we got those numbers, we couldn't use them. We went through a cycle of being surprised to a good surprise from a bad surprise. We made an official request. We obtained the data. At the beginning, perhaps there was a lack of transparency. Afterwards, there was an understanding on part of the government that transparency had not been entirely respected. But the fact that we got the numbers was satisfactory to us because it meant that we were able to look at a 5-year planning period. Transparency is something that everybody has to learn as they go, whether it comes to the government or those who conduct financial planning. Over the next few years, for the next few forecasts, I'm hoping that that element of surprise will be eliminated. And as Parliamentary Budget Officer, I hope I will always have access to the numbers. Chris will come back to your question, or if you like, he can answer your preceding question immediately.
Again, I've spoken to Department of Finance officials, and I don't have direct knowledge of where the $3 billion came from. But my guess is that it is essentially a holdover from the $3 billion contingency reserve that was used by previous governments, and it was just easily mapped into roughly $20 billion or $3 billion on federal revenues into the current forecast adjustment. But your point about the prudent forecasts in the budget, I think if you'll take a look, I think at least our reading is that the use of the forecast adjustment isn't really for prudence. At least I couldn't find an explicit mention in the budget about that. Rather, it's about taking account of the downside risks. And if you will look back at the 2015 fall update and the February Canadian Economic Outlook, that's the way the language is presented, which as a forecaster is what you want to do. And it's in that sense that we thought that this forecast adjustment, specifically in the first year and the second year of the horizon, was excessive. That this wasn't really, at least on the surface, about prudence. It was to balance the risks. And so you would really have to have a very negative scenario with a high probability of it being realized to justify a downward adjustment of $40 billion like that.
Okay, thank you. And we'll go to Mr. Sorbera for 7 minutes.
Thank you, Mr. Chair. Just to quickly speak about something Mr. Caron had mentioned about this being potentially Paul Martin 2.0. I think if we are entering a period of Paul Martin 2.0 here in Canada, and for the next several years we see strong economic growth and a number of good things and strengthening of CPP and working with the provinces on a number of matters, I think that's a great thing for Canada and for my riding of Vaughan Woodbridge. So I will applaud that. Thank you, Mr. Caron. On the issue of prudence, in a former lifetime, I was a bond analyst, and one of our jobs is to look at tail risk and to look at what may happen on the downside. And I think if you look at last year, in the last 18 months, or 18 to 24 months, and you've seen where commodity prices have gone, and you continue to see a transition with the Chinese economy, going from an industrial-led economy to a consumer-driven economy, and some of the challenges that we've seen in volatility in emerging markets, the budget, the 2016 budget contained an amount of prudence, the $40 billion adjustment to nominal GDP, which, from my point of view, is actually being very prudent. It's being prudent to taxpayers. It's being prudent in terms of the economy and to making sure that we look at it in a big picture approach, but also taking into account the issues at hand in terms of the volatility. So I do want to put that on the record, and I'd be happy to hear your comments. But I also wanted just to ask Mr. Cameron again, the issue in terms of the adjustment from old age security and GIS from 67 to 65. Can you just reiterate what that actually meant on a percentage GDP basis going out on that? Because I think it's important for us to note.
Certainly. So on that note, we started off at 0.35% of GDP in 2029, and by the end of our outlook here, I think we showed up till 2067. That has dropped, or 2065, that drops to 0.15% of GDP, so it halves basically over the outlook, and that's a result of these demographic movements and the program parameters.
Because I think it is a point that is worth taking, and we developed economies across the world do face demographic challenges, but this adjustment in policy in returning the old age security and GIS from 67 to 65, where we do note our predecessor announced this change in Switzerland without consultation to Canadians, is actually does not in any way impair our financial wherewithal, our financial flexibility as we move forward. And that's my interpretation. You don't have to comment, but I just wanted to put that out there as well. And Mr. Chair, I do wish to give a minute of my time to Mr. Champlain. Mr. Champlain?
Monsieur le Président, d'abord, Monsieur Fréchette.
Thank you, Mr. Chair. First of all, Mr. Fréchette and your colleagues, thank you. We very much respect the work that you do, and we appreciate that you're here today. The work that you do to inform Canadians and parliamentarians is important to us, and I can assure you that we will cooperate entirely, now and in the future. I want to come back to the matter of prudence, which is an important matter. The Governor of the Bank of Canada talked about volatility in the world's economy. We know that Canada represents about 2% of the world economy. We analyzed the most serious risks in the world economy. We talked about China, the United States. We could even talk about Brazil. The International Monetary Fund recently reduced its growth forecast for Canada. Could you tell us how you integrated the macroeconomic risks in the world economy into the forecast, because what we're saying is that indeed 2% of the world economy is significant for us. We need to look at what's happening in the world. And the economic actors around the world indicate that there's a lot of volatility. Ms. Lagarde talked about growth that wasn't necessarily anemic, but a period of anemic growth. Could you talk to us about macroeconomic measures in the world economy that you took into account when you did your own projections? Thank you for your support for the Office of the Parliamentary Budget Officer. We're very pleased to see that in your platform you gave us a clearer mandate and a stronger mandate, and we're pleased to note that. I will ask Chris to talk to you about prudence, because that's one of his specialties, and he will be able to explain the matter to you in detail. Thank you, Jean-Denis.
In our projection, we incorporate the external outlook essentially through the U.S. economy and through commodity prices, as well as the rest of the world economy, which we look at and is informed by the International Monetary Fund. So in our recent projection, we made significant revisions, downward revisions, to the outlook for U.S. real GDP growth from 2.6 to 2.1, from 2.6 to 2.3. As well, we reduced significantly the outlook for commodity prices, reflecting the weaker global environment. So these are the main channels that are sort of the global macroeconomics are affecting the Canadian economy. But at the same time, we have a fiscal policy that provides an increase to aggregate demand in the economy, and monetary policy that maintains its current interest rate at current levels to accommodate this. So this provides an offsetting stimulus to the economy. On the question of prudence, our projections are what we call balanced risk, and that we think that the upside and the downside possibilities are roughly balanced. And as a forecaster, this is what you want to do if you are concerned about forecast accuracy. If you want to minimize the size of your errors, you want to take into account the balance of risks. A prudent forecast is different in that it wants to ensure with a high degree of probability of meeting or exceeding a target. Now, they may seem like the same things. Prudent, it may sound prudent in both cases, but we think of them as very distinct approaches to forecasting. And then in the current budget, our reading of it, and based on the fall update and the February backgrounder, is that the forecast adjustment had been used to balance the risks that the government saw to the private sector outlook, and not so much as prudent budgeting, which, again, if the government's decision is to make this adjustment to increase the degree of prudence or ensure with a high degree of probability of achieving its target, then it can be transparent and say, we are making a prudent decision. But my reading, you can do a word search in the budget document, prudent does come up, but not in that context.
Suggesting the minister use the word prudent more often. No question. Mr. Abdultaf.
Well, thank you very much. Actually, we know that we run into a big uncertainty over what's happened with the international economy, decline of commodities, which were for the longest time the main engine of what's going on and all the economic growth that we've seen in the past. Now, we have a federal budget that suggests we're borrowing $30 billion. Canadians are asking about this large sum of money that we're borrowing just the first year and moving forward for the next years. The question always arises on how the economic impact, what these estimates are going to leave an economic impact of this neoliberal spending. It's very important to know that from the expectations or the estimates that the budget come up with versus what you can see yourself from your perspectives How can we balance those views? And do you see that the estimate was wishful, or what's the base of reality there?
Thank you. I mean, we have taken into account the fiscal measures, the impact of the fiscal measures that the government introduced in the budget and before the budget. So our projections reflect those. And we have shown the impacts as being 0.5% growth in the first year in 2016 and about 0.3 percentage point in the second year in 2017. Now, that's slightly different from what the government had proposed, but as we said earlier, those kind of small differences in terms of the impact is really a function of the assumptions that you're making in your models and the multipliers that you get from your models. So it's explicable. You can explain those differences. It's not major.
Another question is again, the question comes about the job creation. There's an estimate there. I believe that you took a name at the finance minister on the job creations calculations. Can you explain how he got it wrong? I believe we in the United States, they went through the same thing in the past, in the 2008-9, and there was at least some calculation method over the spending or stimulus package versus job creation. How did the finance minister got it wrong in Canada? Seems, in my opinion, that the numbers don't add up. And I guess probably your opinion is the same or close enough on the same level too.
Sir, we wouldn't say that he got it wrong. It's an estimate, and we have an estimate that is slightly different. And as I said, you have to look at these kind of estimates and results as a range of possibilities rather than in precise estimates. When the Department of Finance estimates the jobs at 100,000, it's something that is coming from the models that they have with the assumptions that they have made. We have an estimate about 60,000. I mean, you can look at that as a range of possibilities, not necessarily precise numbers.
Huge gap right there, and really, I mean, anyone can say this is the way I measure, and this is the result I'm going to expect on the ground. How can we see Canadians need some clear answers? Like they expect some strong, solid ground answers to why the spending is and how what the outcome is going to be.
Well, unfortunately, these things cannot be precise. And another thing is that, again, unfortunately, over time, it will be very hard actually to determine who was right or wrong, because things will change over time the next 2 years, and we won't know whether 100,000 jobs were created because of the programs or 60,000. It's impossible to do that.
Okay, I'm going to have to cut you there, and I'll take two more questions in this discussion period, Mr. Graywall and Mr. Leipert. Then we're going to move to C2, and we'll limit the questions, if we could, to 3 minutes to keep it pointed on C2. Mr. Graywall.
Thank you, Mr. Chair. I'm going to jump right into it. In your report this morning, you are forecasting lower deficits than the minister and the government is, and predominantly you're saying it's because of the $6 billion fiscal impact that the government has put in place. Are you saying that this building in a fiscal impact is not a good decision, because the government's made a commitment to be open and transparent with Canadians, and that as economic conditions change, we will update Canadians? The $6 billion fiscal impact, yes, although larger than in previous years, is meant to ensure that there's been a lot of fluctuations in global commodity prices, which will affect the Canadian economy. So why is it that you guys are building in a lower fiscal impact into your report, given that international commodity prices are still very volatile?
Chris? Quickly, just to respond, I think it's helpful to look back at there have been significant revisions to oil prices and commodity prices since the late 2014 period. But now we're at a level where it's unlikely that we're going to see the same kind of downward revisions. The price of oil, I don't think, can go negative. We're around $40 right now. So adding that or subtracting that $40 billion off of nominal GDP is almost like, in some ways, thinking that oil is going to keep falling to minimal price levels. It's a possibility. It could be a tail risk, but again, tail risks have very small probabilities attached to them.
Okay, so you're basically saying that because the oil price has leveled off between $35 to $40 per barrel, that the government is doing too much in the government's $6 billion fiscal impact assessment?
Essentially, because in late 2014, remember, oil was over $100.
Yeah.
And now it's down to 60.
Yeah.
So over that period, that's on nominal GDP, I think the revision might be around $80 billion for 2016 or 2017 levels. So it's almost like thinking of below 20, maybe $10 per barrel.
Okay.
And that's
I still think it's prudent budgeting on part of the government's budget to ensure that, there is this flexibility. Like in a previous career, I was an analyst, and we always used to build these things in, even on the smallest things. So like I used to be for a beverage company, and we used to do it on our commodity, which was at that time the price of oranges and the fluctuation there in the exchange rate. So I still think it's very good fiscal policy to ensure that this $6 billion contingency, it's honest with Canadians that, we cannot control certain things in terms of commodity prices. But let's not belabor the point. Let's move on. You guys also say in your report that the federal debt to GDP ratio will be at a lower level by 2021, and that moving forward, even you guys have extended your projection over the 5 years to say that given current fiscal policy and current fiscal structure, that the government is doing a good job to help grow the economy, and that our investments are sound given our economic position today. Is that true? Or your comments on that?
That's what we said. What we said is that in terms of fiscal sustainability in the long term, if everything stays as it is right now, you don't introduce new measures. What we know right now is what you see is maintained over the long term. That's exactly the graph that you have on figure 6, which eventually the debt to GDP ratio will go to 0. So that means that the government has a fiscal sustainability. By the way, we can have a report in in July or June, which is our fiscal sustainability report, which is the report that covers all the details of that kind of measures.
Thank you so much.
Thank you both. And I would ask, we'll go to Mr. Leipert, but if I could ask I expect when we're into the next round of questionings, we may still need you, Mr. Mateer and Mr. Cameron. So if I could ask Ms. Leo and Miss Melenik to come to the table on the corner there as well, so they're there for C2. Mr. Leipert.
Just want to pursue a little bit more of the modeling that you used relative to the jobs, because one of the things that we continue to hear is that it's an investment in infrastructure, this particular budget, yet in the first 2 years, if my eyesight is still correct, the actual investment in infrastructure is only in the range of $10 to $12 billion. There is, however, other government spending, which would be, I don't know, CBC as an example. Presumably for that extra several hundreds of millions of dollars annually, there's going to be jobs created there. Did you do any modeling as to where these new jobs are going to be created, whether it's 50,000 or whether it's 150,000? Where these new jobs are going to be created, how much is really going to come out of infrastructure spending, and how much is going to come out of other spending?
Yes, in preparing our estimates of the job impact, we followed Finance Canada's mapping of the measures into the targeted sectors. And so in preparing those estimates, we do have a jobs impact by high-level sector. So if it was measures to support low and modest income households, there would be a measure for that. Other government spending, as you indicated, that would have a jobs impact number as well. I don't have those numbers in front of me, but those are, we could provide those detailed breakdown.
I would like the breakdown because I think it's important that we know if we're going to be running a deficit of $30 billion, as an example, how many of those unemployed electricians who are no longer working in the oil sands are going to be working in Mr. Sorbera's building new condos in Toronto. So if you could now, go ahead.
We do have the breakdown by the targeted area, but we don't have results by sector or by sort of geographic region.
Targeted sector then?
Oh, like let's say a manufacturing sector or agriculture. We don't. Our model's a very highly aggregated macro model.
So what do you? I'm sorry. Then what do you have?
We would be able. We have estimates of the impact on the employment level for the entire Canadian economy, and we're able to link those job numbers with the measures that were proposed using finance's mapping in terms of whether the increased spending is going to show up in investment in non-residential structures or in residential structures. So that kind of detail we would have.
Okay, well, I'd be interested in that as well. Just another quick question before we move on. Also in your modeling, did you do any work around, there's a lot of debate on the new child tax benefit and the actual benefits to an average family, I guess is the best way to put it, versus the tax benefits that were canceled in this budget. Was there any modeling on how those two would compare?
You can volunteer with me doing that one.
We are going to actually, we are working on a report that will look at the child benefits, the new child benefit program with the distribution and analysis of that. So that will be ready hopefully in the next few weeks, and we haven't finished that, but it will come out.
Would you also be incorporating into that, though, the fitness tax credit and the arts tax credit and the income splitting as well? No. Or would it be strictly just the two kinds of child tax benefit?
Actually, to follow up on the point made by Dr. Ascari, we're actually working on two requests right now. So the first is the detailed micro-distributional analysis of the pre and post child tax benefits. And as well, to your point, we're actually doing a more comprehensive overview of the tax changes seen in Budget 2016, both on a pre and post basis, and looking, again, more on a micro basis at specific types of families.
Yep, perfect.
Thank you very much. You'll have to remain in suspense, Mr. Liepert, for 3 or 4 weeks on what the outcome of that'll be. We will turn then to C2, and on my list I have Mr. Lefebvre first, then Ms. Raitt, then Mr. Caron, and we'll try and hold it to 4 minutes each during this round, if we could. Mr. Lefebvre.
Thank you, Mr. Chair. I want to talk about the TFSAs, and obviously the C2 addresses that, and obviously reduces the limit from 11,000 and to the 5,000. Now, by income group, what percentage of Canadians are currently contributing the maximum amount of their TFSAs?
Well, in general, about 18% of people who hold TFSA have maxed their contribution. In general, 18% of Canadians. 18% of those who have TFSA have maxed their...
Okay, and what are their income profiles?
You want to give them the income?
By income profile, and again, we're working with the identical data that Finance Canada is working with that they offered and they testified to the committee last week. That's the 2013 CRA data. But by income group, you roughly see that individuals who filed T1 returns and who claimed that they had total income of $45,000 or less, on average, they maxed out their TFSAs at a rate of around 15% overall. And the rate for individuals who were claiming higher income on their T1 returns, so above $45,000 per year, they were maximizing at roughly 19 to 20% overall.
Sorry, 19?
19 to 20%. So 1 in 5 Canadians in 2013 who had a TFSA, who earned more than reported income of more than $45,000 a year, roughly 1 in 5 of those were maximizing their TFSA.
The reduction of from 11,000 to the 5,000 limit, how would that affect the aggregate savings of Canadians?
I think the short answer is we don't know. So it's difficult to know based upon people. We have historical data of what was happening when people were able to set aside the $5,000 or $5,500. We don't actually have access to data with respect to the doubling of that rate, so for the $11,000 per year. What we can point back to, of course, is our publication from last year with respect to the TFSA program. And what you saw, in particular for the first few years of the program, were that people were actually transferring wealth, so accumulated wealth in non-sheltered accounts into their TFSAs. And again, as we pointed out in that paper, that one would assume or presume that over time, as that stock of wealth that was unsheltered previously slowly dissipated over time, that the contribution rates and the maximization rates would begin to drop.
What, in your estimates that you have when you were looking at the TFSAs, if we would have been allowed to continue to grow, how much of that wealth would have been put into that into those TFSAs, from based on the average of what was occurring right now? So if 11,000, the 11,500 limit, sorry, the 11,500 limit would have been continuing to grow over the years. I know that you guys had projected that how much money of that would have taken outside of the economy, and the fact that it would not be taxable, how much that would hurt the Canadian tax base.
The long-term estimates, and again going back to our publication from last year, the longer-term estimates would put us pretty much on par with the existing RRSP program in the longer term, so going up to 2075. So overall, around roughly 0.6, 0.7% of GDP.
We'll have to leave it there, Ms. Rayett.
Very much, Mr. Chair. I'm going to talk about the TFSAs as well, if you don't mind. I'm going to give a great commercial for the Globe and Mail today, who has a very nice centerfold with respect to how you can actually save money in a TFSA, how much you put in the beginning, and what kind of returns you can get depending. So I would commend that to the government to take a look at the opportunity cost that we have now going to experience as a result of lowering the level. But my question is, in analyzing TFSAs, did you do a comparison to how the United Kingdom approaches their own approach to TFSAs, and I think it's called the income savings account?
No, we didn't do a direct comparison with the individual savings accounts. It was something that we did cover in the annex of the paper that we published last year, so both looking at the examples from the UK, the US, and Japan.
And have any of those countries rolled back, or have they increased their ability to submit or to input to the TFSA? Have they increased their limits? Are you aware of it?
I'm
they
not
have.
not
the answer is yes, they have.
Yeah, okay.
Just let you know.
You seem credible.
I am. Thank you. Thank you. They don't think so. That's unfortunate. The other question that I had with respect to TFSAs, your understanding of TFSAs in the paper that you produce, of course, is that TFSAs are significantly different from our RSPs in that you can take out the benefit or the income that you're generating on the TFSA and use it for whatever purpose that you may want to use it, and it's tax-free. Do you talk about different kinds of examples of what you're saving for as opposed to focusing on retirement?
Sorry. No, that was outside the scope of the paper. Okay. And again, we were primarily or almost exclusively focused on the fiscal impact, so the fiscal cost.
Finally, you do mention that TFSAs were put forward as a tool for sheltering retirement savings when you convert at a certain age group. Do you know what economist out there at what company actually was the one that wrote the paper and recommended that that approach be taken as a tool and the utility of it? He knows the answer.
No, I don't know the answer, but I'm betting you do.
I do, and it was Morneau Chappelle, actually. That was the one that said TFSAs were a great way in order to make sure that you shelter yeah. And that's why he interrupted. Thank you. Thank you very much. Thank you, Mr. Chair. I'm done.
You're done? You have no more answers to give us? Okay, then we will
have a minute, I can spend the rest of my time refuting the suppositions that your government members have said, but nonetheless.
We'll turn to,
I appreciate your humor.
before we get into that, we'll turn to Mr. Caron.
Merci beaucoup.
Thank you very much. Bill C2 is a bill that is of particular interest to me, and I would like to thank you once again for having worked on what I asked you, which was to compare what was in Bill C2 when it came to reducing the second tier of taxation, which affects everything over $45,000 up to $90,000, and compare that to what we had proposed, which was reducing by 1% the first tax tier, which would affect 93% of Canadians, or rather 83% of Canadians. Nobody under $45,000 is going to benefit from the reduced tax level. I would like you to confirm, based on the numbers and the studies that you have, someone who's earning $210,000 would get more in terms of tax breaks than somebody earning $62,000 per year. Thank you for the question.
Our colleagues, Ellen or Carly, to answer that question.
Is the question, is someone earning $210,000 benefiting more from?
Oui, recevrait une réduction d'impôt totale plus grande.
Yes, would receive a greater tax break than somebody earning $62,000, despite the fact that there's another tax tier after $200,000 of 33%. My calculation is that someone who earns $210,000 would get a significant tax break, higher than someone who is earning $62,000.
Okay, so someone who is earning above $200,000, $210,000 in this case, they will be benefiting from the middle tax cut as well, the reduction of 22% to 20.5%. As well, if they are earning above $200,000, they'll be paying 33% on the additional amount that is above $200,000.
Confirmer en fait que le niveau à partir duquel
The level at which people in that income level start paying more taxes because of changes, it's as of $217,000. Is that confirmed? Yes. All of the income between $200,000 and $217,000 will experience a positive effect because of this measure. The work that I asked you to conduct, the reduction of 1% of the first tax bracket, would have allowed people over $200,000 to pay more taxes than the current situation.
For the record, when you folks shake your heads, it isn't in the record. You might want to say yes or no. Dr. Esquerra?
Yes, actually, your first point, people under 217,000 will benefit from the yes, definitely, and then the 30%, 33% will essentially start after that. Yes.
Au bout du compte, à peu près le tiers des contribuables vont gagner.
About 1/3 of taxpayers are going to win, but the rest will not benefit from the proposed tax cut. That's the conclusion that you had drawn as well? About 30% was going to benefit. 31% of the Canadian public, yes. Whereas the proposal that we had put forward, which was 15%, would positively impact 83% of taxpayers. Was that your conclusion? Yes, in our report, that's exactly what we indicated. Changing the first tax bracket from 15% to 14% would benefit 83% of taxpayers. We have to understand that by starting lower, obviously we're capping certain taxpayers. That implies that the other tax brackets will be affected because we're starting at a lower level. In the end, Bill C2 taxes about 1% of the population more in order to redistribute that to about 25% of the public, for example, 31%. There's not a change for about 70% of the public, even though this measure was supposed to be benefiting the entire middle class. If my memory is accurate, in our report, 83% refers to the first tax bracket. In our report, what we indicated was that the second tax bracket, if we start there, as proposed in Bill C2, 43% of taxpayers would be impacted. But 43% includes not only taxpayers in the second tax bracket, but also the third and other tax brackets.
Mr. Ouellette, 4 minutes.
Merci beaucoup, Mr. Chair. I'd just like to know what the impacts of high or low federal debt on economic growth are, and what factors should the federal government consider in determining an appropriate target for the federal debt to GDP ratio.
That we didn't have time.
Mr. Focus. Federal debt to GDP ratio, there is really no optimal level of federal debt to GDP ratio. It is something that really it's very hard to determine. It depends on the situation and circumstances. There are some estimates out there. Some people talking about 80%, 60%, but it's really not determined what the optimal rate is, and that's not something that we are actually focusing on in our reports. What we look at normally is whether the debt to GDP ratio is stable or whether it's declining, which sort of determines whether the fiscal structure is sustainable or not.
Okay. So what would be the impact of extreme poverty on economic growth?
I'm sorry.
C'est quoi l'impact de la pauvreté?
What is the impact of extreme poverty in Canada on economic growth?
That is not something that we have looked at, unfortunately, in terms of the impact of poverty on economic growth.
Is that something that should be taken into account?
Well, I think what we are doing typically is we look at the economic condition and do our projection, but we are not looking at a specific part of the population, how that will affect overall growth in the Canadian economy. Certainly, there are impacts. I mean, poverty, obviously, people cannot spend money and will be an impact, but it's not something we have looked at.
So, from what I understand, then you're looking at things from a very unidirectional or very unidimensional regard, or look at the whole issue surrounding economic growth in the budget?
Yeah, I mean, our really interest is at the end is the budgetary matters, and so to do fiscal projection and to see how the fiscal situation is evolving, we need to have a view of the overall macroeconomic conditions and development, and that's what we focus on. I mean, very detailed micro analysis of the different groups and different income groups in terms of how they're going to affect the economic growth. This is not something that we have done. It would be interesting to do, but that's not something we have done.
But it could be conceivable, for instance, if we had more investment in trying to eradicate a lot of the extreme poverty that exists in Canada among especially children, that the long-term benefits to economic growth might come about, that actually might see a long-term increase in the economic potential of Canada and eventually all Canadians.
As I said, certainly, I mean, those are all possibilities, that investment in education, investment in health, and investment in children may eventually add to productivity and economic activity, but those are sort of general principles, yes.
Okay, thank you very much. And I'd just like to share a bit of time with the Parliamentary Secretary.
We'll have time to come back to him. I'll go to Mr. Abdullah, and then we'll come to Mr. Champagne. That way you'll have a little more time.
Well, thank you again. The question is, how do we identify middle class in Canada in terms of income, structure, and in terms of the overall Canadian economy? Can you advise us the percentage of Canadians that to be considered as middle class?
The definition of middle class really is a political definition. It's not a mathematical or economic definition. I mean, depending on what ranges of income, what level of wealth you decide. People have different views of the middle class. There is really no one definition of middle class. I mean, it's not something that we necessarily focus on deciding exactly what the middle class, which income level to which income level. I mean, that could vary in different circumstances. So. Unfortunately, I cannot advise you on what the middle class is.
Yeah, I just a quick question. In modeling that you would do fiscally, I'm presuming there's a time frame that you would like to use for a new program whereby there's kind of a maximum take-up on it, if you might. So the TFSAs are a relatively new program, but 7, 8 years, something like that. In your estimation, what time frame would you need to really assess whether that people are, aware and have the ability and are maximizing their ability to contribute? What would be an estimate that you might say would be fair?
Well, I mean, it's very hard to put really a time limit on this, but the fact of the matter that any kind of a program like TFSA, which essentially is a savings program, over time, as that limit of saving increases, it's a reality that people who have higher income and higher wealth can benefit more from that program. It's much harder for an individual with a $50,000 income to find $10,000 savings every year than for somebody who is making $200,000 a year. So it's in the beginning, yes, in the beginning, the TFSA program, people move their assets from what they have already saved into TFSA to take advantage of the interest-free return. But over time, it becomes more and more difficult for those people, and so the benefits will go to higher income people. But exactly what time frame will show that I cannot say, unfortunately.
We got more time?
You do. You got 1 minute.
Then I would like to, on that same modeling, get your opinion on whether or not, because one of the criticisms or one of the rationale for ratcheting back the decision to increase the maximum was that people weren't contributing to their maximums. Would you say that, given the short time frame that it was there, that wasn't given a fair assessment?
Well, what we have seen is that up to 2013, 18% of people who are TFSA had maximized their contribution. What has happened since then, we don't have that information, so we can't really tell. And as I mentioned, I mean, in principle, as we move on, that percentage probably is going to drop because fewer and fewer people will have the capacity and the financial resources to benefit from the maximum amount of TFSA.
Thank you very much, Mr. Leipert, Dr. Escara. Mr. Champagne.
Bonjour, Monsieur Ascari. Permettez-moi.
Hello, Mr. Escari. Please refresh my memory. I think only 6.7% of Canadians contributed to the maximum, the cumulative maximum of $41,000. Can you confirm that for me? 6.7.
I'm happy to go in English. So I think if you look at the TFSA, if you look at the cumulative maximum that you could contribute, which is 41,000, refresh my memory, but I think I've seen that only 6.7% of Canadians have contributed the maximum cumulative amount that you could contribute in a TFSA.
Yeah, no, I believe that statistic, although technically correct, actually includes a base of all Canadians, including those who haven't actually opened TFSAs. When you actually look at the individual Canadians who have actually opened TFSAs, the actual statistics from the Canada Revenue Agency as of 2013 was closer to 18%.
But 6.7% is still a valid point of reference. I mean, you just disagree with the premise, but I mean, it's a valid statistics as we look at that. So you might agree that we have decided to do differently to cover more people. Laissez-moi juste survenir, Monsieur Fréchette, en français.
Mr. Fréchette, the fiscal measures announced for the middle class are measures that affect about 9 million Canadians. Do you have that in your numbers, the number of Canadians who are going to benefit from the middle class tax cut? No, we don't have those numbers. As we mentioned earlier, we can't precisely define the middle class. As we do not define that in our reports, we did not establish that. Can you tell me more, from a macroeconomic point of view, the impact of those types of tax cuts? Have you noticed, can you talk about the positive impact of such a tax cut to stimulate economic growth in the country? Do you have any numbers on that? Or Mr. Prudence, or Mr. Mathieu, rather, can tell us more about the positive macroeconomic impact of that type of measure? The measures we have in today's report take into consideration all of the budgetary measures announced. It's an aggregate that you see in our report today. It includes the reduction made to tax cuts, but not only that.
Ultimately, these measures will have a sizable impact on the Canadian economy. So when you were commenting on that, and I think it's taking out a quote of your report, can you expand on the measures you were referring to say that they will have a sizable impact on the Canadian economy, a positive sizable impact?
Toutes les mesures qui ont été annoncées.
All of the measures announced in the budget are included in that statement that you just quoted. All of the measures indicated, which we have in Table 1, or rather Table 3 of the Executive Summary. All of the budget measures are going to have a positive impact. The 6 or 7 measures, the broad lines that had been announced. Over 2 years, the 2 years we had, it is exactly those measures that were taken into consideration in our report. Perfect. Thank you, Mr. Chair.
Mr. Champagne, I have one last question, I guess, Mr. Fischette. I don't think there's any question that most of us believe that the Parliamentary Budget Office should be an ally for Canadians and actually for the Department of Finance in terms of improving our transparency and the visibility of the numbers to Canadians, and shouldn't be an opponent. I believe it was April 6th in a report you outlined a number of concerns regarding the presentation of the federal fiscal plan. Have those concerns that you raised at that point, have they been addressed? Or if they haven't, which ones as yet are to be addressed from your perspective? I know there's always different opinions here, but I guess has the Department of Finance sufficiently addressed those concerns that you raised? I think it was, I might be wrong on the date, but I believe it was April 6th.
Question, yes, they did. I mean, as I said before, previously in this meeting, we received, the problem is that we received the data. After that, we were not able to use the data. After that, it was okay with our communication with the department to use the data and to provide it to Parliament. And therefore, I mean, this has been solved. We just hope that, you know, and we will continue our relationship and discussions with departments. Believe me, I mean, with some departments, we have excellent relationship. I mean, I can mention a couple of them, but, you know, they are very open and very transparent. We receive the data that we ask for. As for, I would like to take the opportunity to mention the confidentiality. I mean, there was some attack against the PBO that we would not release confidential data. This is true. It's in the legislation, Parliament of Canada Act, section clause 79.4. Anything that we receive on a confidential basis from departments, we cannot release and we will not release. But we can use it to help us to do our calculation, and that's what we're doing.
Okay, then thank you for that answer. I would remind committee members that if anyone, any of the parties have amendments on C2, they have to be into the clerk by 4 p.m. today. And with that, I want to thank Parliamentary Budget Officer and all of the witnesses that have come forward. And also for the good work that you do on behalf of Canadians. So thank you very much all. Meeting adjourned.